Welcome to the Way of Wealth. I'm Corey.
And I'm Lily. Corey, after our last episode on the gold and silver crash, the comment section turned into two completely different worlds. Some people calmly said this is exactly the time to add to positions big dip, buy big, small dip, buy small, no dip, don't buy. But others were furious, accusing us of hindsight, saying we got the bull call wrong. Same episode, same price, but it's like two entirely different groups of people living down there.
That's a sharp observation, and that phenomenon itself is the perfect opening for today. Same price, same falling chart, two completely opposite reactions. The difference isn't who has more information or who's smarter. It's mindset, or more precisely, what exactly you're holding in your hands and whether you borrowed money to hold it. Those two things determine whether, on the day of a crash, you sleep soundly or stay up all night staring at the screen.
True. One person is counting money, the other is counting losses. So in this episode, let's answer a question many listeners have been asking us privately for a long time. Why do we never talk about trading stocks? Especially with AI stocks soaring the way they have. Plenty of people think it's strange that we're sitting out all the excitement.
All right, today we'll settle this question once and for all. Conclusion. First, we stay out of the stock market. Not because we think we're above it, and not because we don't understand it, but for two very concrete reasons. For the first reason, I won't use my own words. I'll borrow someone else's. A man known as the Oracle of Omaha, Warren Buffett.
What does Buffett himself say? Now I'm really curious. He built his fortune in this very market and became one of the richest people in the world.
At the 2022 shareholder meeting, Buffett publicly criticized Wall Street for turning the stock market into a casino. Then, in his 2024 shareholder letter, he wrote that today's markets exhibit far more casino-like behavior than when he was young, and that the casino now resides in many homes, tempting the occupants every single day.
A casino in your own home. He's talking about the trading apps on our phones, right?
Exactly. The barrier to trading has been lowered to nothing. Placing an order feels like playing a game, complete with confetti animations to celebrate your trade. Buffett's longtime partner Charlie Munger put it even more bluntly before he passed away. He said, "We now have people who know nothing about stocks being advised by stockbrokers who know even less a crazy situation." He even asked, why would a civilized country want its stocks to trade in a casino?
Munger also compared speculation to addiction, didn't he? I remember him saying gambling is like drugs. A certain percentage of people, once they start, just can't stop.
That's right, addiction was exactly the word he used. And it's the same disease as the monetary addiction we keep talking about on this show. One version afflicts central banks. The other afflicts retail traders. Then, at last month's shareholder meeting, the 95-year-old Buffett went even further. He described today's market as a casino built right next to a church, and the casino side keeps getting busier. He said that in 60 years in this business, he has never seen people this eager to gamble. On zero-day options, the ones that expire the same day you buy them, he said it flat out. This isn't investing. It isn't even speculation. It's gambling. Pure gambling. And what's even more telling is his action. Buffett stepped down as CEO at the end of last year, but Berkshire's cash pile has grown to nearly $400 billion. He says that, in 60 years of doing business, there were only about 5 years when bargains were everywhere, and when he can't find anything at a reasonable price, he would rather do nothing at all.
Calling the market a casino with his words, while sitting on the largest cash pile in history with his hands, the Oracle is expressing his view of this market with real money.
So why did it become a casino? Think about what the stock market is supposed to be. It should be a barometer of the economy, a window into the real world of business. A company runs well, sells products people want, earns real profits, and its stock rises. It's mismanaged, keeps losing money, and its stock falls. Prices orbit value, and capital flows to where it's most productive. That's the whole reason stock markets exist.
But today, what I see looks nothing like that.
Today, the entire logic has flipped upside down. We talked about it just last episode. A strong jobs report. Clearly good news for the economy. And the market crashed. Why? Because nobody is betting on corporate earnings anymore. They're betting on the Fed's next card. Rate cut, everyone cheers. Rate hike, everyone runs. Prices no longer reflect how the economy is doing, they reflect which side of the table the chips are stacked on. You'll even see something more absurd. Unemployment numbers get worse, and the market pops champagne, because bad news means the central bank might turn the liquidity taps back on. A market that cheers for unemployment, who could honestly call that a window into the economy?
So calling the whole market a casino isn't an exaggeration at all. The bet isn't on the value of businesses, it's on the mood of the central bank.
And that's reason number one. The market no longer prices the real economy. It prices the gamble. Our time and energy are limited, and we'd rather not spend them guessing how other people will bet. The second reason worries me even more: leverage.
Leverage. Borrowing money to make your bets bigger.
Right. And this time, leverage is stacked through the entire chain, top to bottom. On the corporate side, companies are issuing debt at a furious pace to fund the AI arms race. Tech sector bond issuance topped $200 billion last year alone, and JP Morgan estimates that AI-related companies may need to issue as much as $1.5 trillion in investment-grade bonds over the next 5 years to build all those data centers.
And on the retail side, individual investors are borrowing money to buy shares of companies that are themselves expanding on borrowed money. The entire industry chain is soaking in debt.
You've hit it exactly. And I've seen an even more dangerous signal. Many young investors, watching AI stocks surge, have been rushing into the market with borrowed money, taking out loans to buy stocks, and then adding margin on top of that, hoping to multiply the gains several times over.
A loan plus margin. That's a bet stacked on top of a bet. Win, and you multiply your money. Lose, and even the principal was never yours to begin with. How big is this, exactly?
It's not isolated cases, it's a market-wide phenomenon. Margin debt at U.S. brokerages. The total amount investors have borrowed from their brokers to buy stocks hit another all-time high in April, topping $1 trillion. And adjusted for inflation, margin debt has grown more than 5-fold since 1997, while the market itself has only grown a little over 3-fold. The borrowing is sprinting far ahead of the market.
That picture feels familiar. Isn't it a lot like right before the dot-com bubble burst in 2000?
It's more than just similar. The Buffett indicator, total stock market value relative to the size of the economy, and the Shiller P/E ratio are both back at levels last seen on the eve of the dot-com crash. In other words, a generation of young investors who have never lived through a real bear market is using borrowed money at historically extreme valuations to chase the hottest theme on the board. Margin levels have even surpassed the wildest days of the meme stock mania a few years ago.
Walking into a casino on a loan. Corey, this is the margin call chain reaction from last episode, isn't it? Once prices fall to a certain point, leveraged investors get forcibly sold out. The selling pushes prices even lower, which triggers the next wave of liquidations layer dragging down layer.
You remember it well. Leverage is a pair of wings on the way up and a stone tied to your ankle on the way down. The cruelest part is that at the moment you're forced to sell, you have no choice in the matter. It's not that you misjudged the company or misread the trend, the margin system simply carries you out of the building. And by the time prices bounce back, your chips are no longer on the table.
When I think about those young people who went in on borrowed money if that day really comes, what they lose isn't just the numbers in an account. It's debt they may spend years repaying.
That's what truly worries us. Winning or losing inside a casino is one thing, but walking into the casino on a loan means losing years of your future. And leverage liquidation never shows mercy. It always arrives at the exact moment prices are lowest and you're least able to come up with more cash. We can't stop anyone from entering the market. All we can do is explain the mechanism clearly.
So back to the question we opened with, facing the same crash in gold and silver. Why could our listeners stay so calm?
Because with physical gold and silver, you buy only what your money can pay for the oldest, simplest rule there is. No margin calls, no forced liquidation, no midnight phone call demanding more cash. However wildly the price swings, nobody can shake the metal out of your hands. Whether to sell is always your decision, and yours alone. Remember, March 2020? Paper silver was hammered down to $12 at one point. It looked unbelievably cheap, but the physical market had no supply. and premiums on silver coins shot up more than 100%. A crash in the paper price has never meant you could actually buy real metal at that price.
And that's why that comment from the opening big dip, buy big, small dip, buy small, no dip, don't buy. The more I think about it, the more conviction it carries.
We agree with it completely, because it's something you can only say after deeply understanding physical gold and silver. The conviction comes from underlying value monetary properties unchanged for thousands of years, real mining costs, a long-standing supply and demand structure. The deeper the price falls, the wider the gap between price and value, which is exactly why you can buy more as it falls. But take that same sentence and apply it to any tech stock, and the logic collapses. Behind a stock is a company, and companies decline, get outcompeted, get delisted, go to zero. A fall may never come back. Buying the dip without underlying value isn't conviction. It's catching a falling knife.
No wonder one listener wrote that after hearing the episode, they felt so much more at peace they'd been feeling trapped in a losing position and almost dumped everything short term, which would have been the real disaster. And another listener put it even better. Let them sell at a loss. The smart money will gladly pick up the treasure.
Exactly right. The only holders who get washed out by deleveraging are the ones holding paper gold and paper silver. Physical holders were never sitting at that table to begin with. And in this round of comments, one listener said something genuinely profound. He said this drop, in the short term, cleared out the speculators who can't tell money from credit.
Can't tell money from credit. Can you unpack that one for us?
Think about it. The dollar, the yen, U.S. Treasuries. What are they? At their core, credit. A promise to pay you back someday. A promise that it will hold its purchasing power. And promises can be doubted. Look around right now. Treasury yields stuck stubbornly high. The yen locked in a tug-of-war around the critical 160 per dollar line it briefly broke through in late April, until Japanese authorities stepped in to drag it back. The market is casting votes of no confidence in those promises, with prices. And don't forget the bigger number behind it all. U.S. federal debt is approaching $40 trillion. Every extra percentage point of interest means an astronomical interest bill. Raise rates, and the debt can't take it. Don't raise them, and inflation can't be contained. The entire casino is built on top of that dead knot.
While physical metal is nobody's promise and nobody's liability, it simply exists. It doesn't need anyone to redeem it.
There's a classic image for this, the inverted pyramid of credit. At the very top sits the largest and most phantom layer, derivatives and leveraged positions. Below that, layer by layer, come stocks, corporate bonds, government bonds. And at the very bottom of the inverted pyramid, the smallest point, the one holding up everything above it, is gold. Because gold is the only asset in the entire system that is not someone else's liability.
So when the credit layers above start to crumble, money flees downward, layer by layer, until it all crowds toward that tiny point at the bottom. A point that small, with that much money running for safety, the image alone is staggering.
And that is the difference between money and credit. Credit rests on someone else's promise. Money's value sits in your own hands. Once you see that layer clearly, short-term swings stop frightening you. If you don't see it, all you can do is sit in the casino, your heartbeat tracking every move of the chips.
Still, Corey, honestly, every time the price drops and the comments fill up with people calling us hindsight merchants or saying we got the call wrong, I can't help feeling a little discouraged. We say it every single episode, don't watch the short term.
The frustration is real, but we understand it too, because everyone measures things on a different timescale. If you judge us by next week's quote, then yes, we'll often look wrong, because we never make short-term price predictions. That's not our job. What we care about is how much purchasing power your wealth still has 5 or 10 years from now. The wrong ruler will never give you the right measurement. And every one of our episodes is published and timestamped for anyone to check the timeline. Doesn't lie. We've never needed to quietly revise our views after the fact, because what we talk about is structure, not the day's price action.
Time will speak for itself. The people who doubted us a year ago have gone quiet. The people attacking us today may understand a few years from now.
One more thing we should make clear. We're not saying stocks themselves are evil. Historically, the stock market really did carry the growth of the real economy. And it gave countless well-run businesses the capital they needed. What we're saying is this: In a market that has turned into a casino leveraged to the hilt and priced off the central bank's mood, we choose not to play this game. Everyone makes their own choices. We're simply telling you, honestly, what we see.
Choosing not to play is itself a position.
So let's wrap it up. We don't trade stocks first, because this market has gone from a window into the economy to a casino. And that's not our claim. It's Buffett's own words. And second, because the leverage inside the casino will confiscate your chips at your weakest moment. The path we've chosen looks slow and unglamorous, but it's steady. No borrowing, no betting on direction, no guessing the central bank's next card, just quietly moving the things that can't be printed and can't be frozen. Piece by piece, back into our own hands. However bright the casino lights shine, it's still a casino, and real wealth has never depended on luck.
It doesn't sound exciting at all. No overnight riches story, no dramatic plot twist. But you get to sleep at night.
And those who sleep at night are the ones who reach the finish line. The race for wealth has never been about who runs fastest. It's about who lasts longest and goes furthest. Next episode, we'll follow the latest developments from the rate decision. Thanks for listening, and we'll see you next time.
Bye, everyone.